Over the last 20 years, not a single active large-cap growth fund beat the market on a risk-adjusted basis. Not most of them, not almost all of them. All of them failed, and the benchmark they failed to beat was simply the S&P 500 Growth Index. This isn't an opinion. This video is built entirely on real-world data and official industry reports. So stay with me, because by the end of this video, you'll understand exactly why this happened. Active fund managers promise one thing: better returns with smarter risk management. Better stock selection, better timing, better downside protection, but promises don't matter in investing. Evidence does. In today's video, we're going to look at 20 years of data from S&P Global, the same organization that maintains the S&P 500 itself, to answer one simple question. Can active managers actually beat a plain S&P 500 growth ETF over the long run? And to make this easy to follow, here's exactly how this video is structured. First, we'll explain what SPYVA is and why it's the most trusted scorecard for judging active managers. Second, we'll break down the magical S&P 500 Growth Index and why it has been so difficult to beat. Third, we'll look at which ETFs allow you to invest in that index and how everyday investors actually access it. And finally, we'll step back and talk about active management as a whole, why fees matter, and why the compounding effect is the real key to building long-term wealth. And once you see the numbers, the conclusion becomes almost unavoidable. This video is for educational purposes only and does not constitute financial advice. Without further ado, let's begin. Before we dive in, for the SPYVA report and other useful materials from S&P Global, I've added the links in the description below, so feel free to check them out. So now we need to answer one question: why should you trust this data at all? Because this isn't coming from me. It's not coming from a finance influencer. And it's definitely not coming from a fund manager trying to sell you something. This comes from S&P Dow Jones Indices, the same company that literally runs the S&P 500. SPIVA stands for S&P Indices versus Active. Think of it as Wall Street's official scorecard. It's been published consistently since 2002, using the same rules, the same benchmarks, and the same methodology year after year. You've probably heard this stat before, that most active funds underperform the S&P 500. And to be clear, that is absolutely true. But SPYVA goes further than just one headline benchmark. It doesn't compare every fund to the same index. It uses apples-to-apples comparisons, matching each fund category to its correct benchmark. So when we talk about large-cap growth funds, the benchmark isn't the plain S&P 500. In this context, the correct benchmark is the S&P 500 Growth Index, the growth half of the S&P 500 itself. And that distinction matters, because this isn't value versus growth. It's not apples versus oranges. This is growth managers versus a growth index, playing on the same field by the same rules. Now here's the part most people don't realize. The active management industry has a quiet trick. When a fund performs badly, it doesn't just underperform, it often gets shut down. The bad track record disappears. The fund vanishes. And suddenly, the performance of surviving managers looks much better than reality. This is called survivorship bias, and it's how failure gets swept under the rug. SPYVA doesn't allow that. It counts the dead funds, the merged funds, the liquidated funds. The ones that failed and quietly disappeared. They all stay in the data, and SPYVA goes even further. Returns are shown using both equal-weighted and asset-weighted results, so tiny funds don't distort the outcome. It also tracks style consistency, so managers can't quietly drift from growth into something safer and still call it skill. And the data is cleaned, no double-counting share classes, no index funds mixed in with active managers, which means what you're about to see isn't an opinion. It's not cherry-picked, and it's not marketing. It's the raw, audited record of how Wall Street's so-called smart money actually performed when no one was allowed to hide the losses. Now that we understand the referee, let's define the standard. Because to say active managers failed, we need to be clear about what they failed to beat. The S&P 500 represents the 500 largest publicly traded companies in the United States. These are the biggest businesses, the most profitable firms, and the dominant players in the global economy. But inside that universe, not all companies behave the same. The S&P 500 Growth Index is simply the growth side of that list. It doesn't add new companies. It doesn't search for hidden gems. It just takes the fastest moving companies from the same S&P 500 everyone already knows. So how does a company qualify as growth? The index looks at three things. First, sales growth, companies whose revenues are expanding faster than peers. Second, earnings momentum, businesses showing accelerating profits. And third, price momentum, stocks that the market itself is already rewarding. There's no discretion here, no opinions, no predictions, just data. Think of it like this. Imagine the S&P 500 as a high school graduating class. The growth index is the varsity athletes. They're not guaranteed to win every race. They're more volatile. They fall harder in bad years. but historically, they run faster over long distances. And here's where the rules get interesting. If you look at the top holdings of the S&P 500 Growth Index, no doubt the big tech companies are in there. However, you'll notice something that feels completely counterintuitive. Berkshire Hathaway appears in the top 10. That surprises a lot of people because Berkshire is almost always described as a value stock, but the index doesn't care about labels. It doesn't care about reputation. It doesn't care about narratives. And it definitely doesn't care what a stock is supposed to be. It only looks at the data. And by the index's rules, Berkshire's earnings profile, fundamentals, and market behavior were strong enough to earn it a place among the growth leaders. That's the point. This index isn't making style judgments. It's applying strict, transparent rules, which means sometimes the outcome feels counterintuitive, but it's also brutally honest. And that honesty is exactly why this benchmark is so difficult to beat. Because active managers aren't competing against an average index. They're competing against a ruthless, rules-based system, one that systematically tilts toward growth, momentum, and scale without emotion or hesitation. And this is the standard that active large-cap growth managers were measured against. Not a straw man, not an easy benchmark, but a pure, rules-based growth engine drawn from the strongest companies in the market. Now here's the practical question. You can't buy the S&P 500 Growth Index directly. It's a benchmark, a standard, a measuring stick. But you can buy the tracker. This is SPYG, the SPDR portfolio S&P 500 Growth ETF. This is how real investors access the exact standard we just defined. SPYG is designed to track the S&P 500 Growth Index using the same rules, the same rebalancing, and the same construction. It doesn't try to outthink the index. It doesn't make active bets. It simply follows it. For completeness, SPYG isn't the only ETF that provides this exposure. There are two close cousins, IVW from BlackRock and VWAG from Vanguard. SPYG is issued by State Street with an expense ratio of 0.04% and around $45.8 billion in assets under management. IVW has a higher expense ratio and VWAG sits in between. All three are liquid. All three target large cap growth. All three track the same segment of the market. The differences are mostly mechanical: fees, scale, and issuer preference. I focus on SPYG for consistency. Its name closely matches the S&P 500 Growth Index, its cost is the lowest of the three, and its structure does exactly what this strategy requires. Now let's look at the results. Over the 10-year period ending June 30th, 2025, SPYG delivered a cumulative return of over 330%. Stretch that to 15 years, and the total return climbs to roughly 9 times the original investment. And over 20 years, SPYG returned approximately 946% in absolute terms. And this is the part most people underestimate. That 946% return didn't come from clever timing. It didn't come from constant trading. It came from the compounding effect of a low-cost, rules-based, established index fund working quietly over 2 decades. 20 years doesn't feel long, but when costs are low and returns are allowed to compound, the outcome becomes almost unbelievable. That's the power most investors never fully appreciate. But performance alone isn't the full story. Look at the risk-adjusted returns measured by the Sharpe ratio over the same periods. Over 10, 15, and 20 years, SPYG consistently delivered solid risk-adjusted performance without relying on timing, leverage, or discretion. Now connect this back to SPIVA. Remember what the scorecard told us. Over these same long-term periods, 97% of active large-cap growth managers failed to beat the benchmark on absolute return, and on a risk-adjusted basis, the failure rate was 100%. This table shows you what that benchmark actually delivered. This is the line active managers couldn't cross. And then there's the cost. SPYG charges an expense ratio of 0.04%. That's 4 basis points. Wall Street typically charges 1 to 2% for active management. SPYG charges 0.04% to deliver the return that active managers failed to beat. And here's the honest takeaway. Whether you choose SPYG, IVW, or VWAG, any one of them gives you exposure to the same benchmark that active managers couldn't outperform. Not because ETFs are magical, but because the math is. So let's step back and put everything together. This video was never about predicting the next stock, and it was never about chasing the hottest fund. It was about one simple question. Can active managers consistently beat the S&P 500 growth benchmark over the long run? After looking at 20 years of data, the answer is clear. According to SPIVA, nearly all active large-cap growth managers failed to beat the benchmark on absolute returns. And on a risk-adjusted basis, every single one failed. Not most, Not almost all, everyone. And now you've seen what that benchmark actually delivered. A low-cost, rules-based growth index, compounding quietly over decades, turning patience and discipline into extraordinary long-term results. No forecasting, no manager selection, no style drift, just math. This doesn't mean active management is useless everywhere, and it doesn't mean markets are always easy, but it does mean this. In one of the most competitive, well-researched parts of the market, large-cap growth, the odds are stacked firmly against active managers. And for most long-term investors, the biggest risk isn't volatility. It's paying high fees for results that data says are unlikely to beat the benchmark. You don't need to outsmart the market. You just need to avoid fighting the math. And sometimes, the simplest solution is also the most powerful. In investing, complexity is optional. Compounding isn't. And the hardest part isn't finding the best strategy. It's sticking with one that already works. If you found this useful and you like research-driven content like this about ETFs and long-term investing, consider subscribing to the channel. I regularly post deep, data-backed videos like this, focused on helping you understand what actually works over time. This video is for educational and informational purposes only. Nothing in this video should be considered financial advice, investment recommendations, or a solicitation to buy or sell any securities. All data and analysis are based on publicly available information and are presented for general education. Past performance does not guarantee future results. All investments involve risk, including the possible loss of capital. You should always do your own research and consider your personal financial situation or consult a licensed financial professional before making any investment decisions.